If you're investing in real estate, owning a great property doesn't necessarily mean you're getting the best tax result. You could be building wealth through real estate and still paying more in taxes than you need to simply because important tax planning decisions weren't made at the right time. Hi, I'm Lisa Marie Odeja, CPA, EA, former federal government auditor, and advanced tax strategist at Pinnacle Financial Services, where we help real estate investors, our firm's primary focus, and profitable business owners legally reduce taxes and build wealth through advanced, defensible tax strategies. Today, I'm going to show you several areas where real estate investors can miss valuable tax planning opportunities, and more importantly, why when you plan can be just as important as the strategy itself. Let's get started. A tax loss doesn't always mean an immediate tax benefit. Here's something that surprises a lot of real estate investors. Let's say your rental property generates a $30,000 tax loss after expenses and depreciation. You may look at that number and think, great, that's $30,000 that's going to reduce my other taxable income. But that isn't necessarily how it works. Rental real estate is generally treated as a passive activity for federal tax purposes, and depending on your particular situation, the passive activity loss rules may limit your ability to use that loss against other types of income. Now, that doesn't necessarily mean you've lost the deduction. It may mean that you can't use all of it right now. And this is where tax planning becomes important because there are exceptions. Depending on the facts, some taxpayers may qualify for the special rental real estate loss allowance. Some may qualify for real estate professionals for tax purposes and materially participate in their rental activities. Short-term rentals can raise another set of considerations. I'm not going to teach all of those rules today because each one deserves its own discussion. But here's what I want you to remember. Having a tax deduction and being able to use that tax deduction today are not necessarily the same thing. And if nobody is looking at how your real estate activities interact with the rest of your tax situation, you could be missing planning opportunities. Depreciation is more than a number on your tax return. Another major benefit associated with investing in real estate is depreciation. Most investors know that rental property can be depreciated, but fewer investors think strategically about when those deductions are being taken. Now, depending on the property and your particular circumstances, strategies such as cost segregation and bonus depreciation may allow certain deductions to be accelerated, and that can produce potentially significant tax savings. But here's the important part. A larger deduction isn't automatically a better tax strategy. Before accelerating a deduction, I want to know whether you can actually use it. What's happening with your income this year? Are passive activity rules going to limit that benefit? What are your long-term plans for the property? And what could happen from a tax standpoint when you eventually sell? Tax strategy isn't about grabbing every deduction as quickly as possible. It's about looking at the entire picture and deciding when the deduction may provide the greatest benefit. A quick question for you. Are you thinking, I own real estate, but I honestly don't know whether I'm taking advantage of tax planning opportunities available to me? If so, there's a link in the description below where you can schedule a discovery call with our firm. Now, let's keep going, because there's another area where real estate investors can easily get tripped up. Your entity isn't automatically a tax strategy. Real estate investors hear a lot about LLCs, S corporations, partnerships, holding companies, and other ownership structures. And sometimes social media makes it sound as though forming the right entity automatically creates tax savings. It doesn't. An LLC may serve important purposes, but simply placing a rental property into an LLC doesn't automatically create new federal income tax deduction. And different ownership structures can create very different tax consequences. So instead of starting with what entity should I create, I prefer to start with what are we actually trying to accomplish? Is the concern liability, taxes, multiple owners, future growth, a potential sale? And those are very different objectives, and the structure that makes sense for one investor may be completely wrong for another. That's why I don't believe tax strategy should be built from a checklist. It should be built around the taxpayer. Tax preparation and tax planning are not the same thing, and this may be the most important takeaway from today's video. Tax preparation looks backward. Tax planning looks forward. When I'm preparing a tax return, we're primarily reporting things that have already happened. The property was purchased, the income was earned, the expenses were paid. This year is over. Tax planning asks a different question. What can we still do while we have options? Should something happen this year or next year? Are there deductions that haven't been considered? Does a change in income create a new tax planning opportunity? Has your real estate portfolio grown enough that your previous strategy no longer makes sense? Could something outside of your rental activity, such as retirement strategy or business strategy, improve your overall tax position? Those are plenty questions. And this is why I encourage people not to wait until March or April to start asking, how can I reduce last year's taxes? Sometimes there are still things that can be done. But sometimes the answer is, we have more options before December 31st. That's one of the most frustrating conversations to have with the taxpayer because the opportunity may have existed. We simply ran out of time to use it. Effective isn't enough. There's one more part of real estate tax strategy that I think deserves more attention, and that is documentation. A tax strategy isn't strong simply because it creates a great deduction. If you're taking a position on a tax return, you should be able to support it. If you're claiming material participation, there should be support for your participation. If you're deducting certain expenses or mileage, there should be appropriate records. If you're implementing a more advanced tax strategy, you should understand what documentation needs to exist behind it. Because when a tax position is questioned, the number on the tax return isn't the only thing that matters. The support behind that number matters too. That's why I always say, the best tax strategies aren't just effective, they're defensible. At the end of the day, it's not what you can take, it's what you can defend. If you're investing in real estate and you're concerned that you may be paying more in taxes than necessary or missing tax planning opportunities, you don't have to try to figure all of this out on your own. If you'd like professional help identifying tax strategies that may help you legally reduce your tax liability and build wealth, simply schedule a discovery call with Pinnacle Financial Services using the link at the top of the description or scan the QR code on your screen. During that call, we'll discuss your goals, your concerns, and I'll explain how our firm works, and then we'll determine together whether we're a good fit to work together and discuss the next steps. Thanks for watching, and I'll see you in the next video.